In today's video, we're talking about how you can make money from a stock going down using a bear put spread, which is an option strategy that makes money when a stock goes down or stays stagnant, and it's good for a low implied volatility environment. So in this video, we're going to talk about what exactly it is, some scenario analysis, and use an example throughout to hopefully make it easier to understand. So let's get into it. Let's say you're trading SPY, which is an index ETF on the S&P 500, and you think it's going to go down based on the fact that it may be overbought, it may be consolidating, and your overall portfolio needs some short delta, or you have a directional bias to the downside. Also, if you'd rather read through the strategy instead of watching this video, you can check out the Patreon link in the description below, and you'll find this article where I talk about the different scenarios as well as the strategy as a whole. With a bear put spread, essentially you're selling a put at the same time you're buying a put. The expiration date of both those puts are the exact same date. So in this situation, May 21st is the expiration date. We're selling the 413 put and we're buying the 416 put. And currently SPY trades at 406, which means both of these puts are currently in the money because you would rather sell at 413 or 416 versus 406, right? So the 416 is more in the money compared to 413. So you're paying a higher price for the 416 put and you're paying less for the 413. When you combine those two together, essentially you're going to be paying to buy this spread. So in this example, to keep things easy, we're going to buy this spread for $2 or $200. I'm using Tastyworks because honestly, visually it's the best platform and it's really easy to explain using the platform. So you can see it knows that I'm buying a put vertical or a bear put spread, right? And the max P&L is 100. So you can make a max profit of $100 and your max loss is what you paid for the spread. So in this situation, we're paying 200 bucks. What you'll also notice is that it's long theta, meaning that when you put on the trade, you're getting the benefit of theta decay. If you're wondering, how do I select the strikes when I put on this trade? Normally what I do is the -70 delta for the short put, and then depending on how much risk I want to take, I'll widen out the long put strike as much as I want. So the more risk I want to take, the wider the width of the strike prices will be. And lastly, I pay around 2/3 of the width of the strikes. It follows very closely to the Tasty Trade methodology, right? I'm looking at 30 to 60 days till expiration, 2/3 of the strike widths, and then also I'm looking at a 50% profit. So for this trade, since I'm buying it for 200, I would try to sell it at 250 to get my 50% profit. So in order to do scenario analysis to say what the max profit is, profit, break even, loss, and max loss, we're going to use an assumption that we're holding onto this spread until the end of expiration, until the spread actually expires. That way we can calculate the value and we can look at the different scenarios and how it can play out. So these are the different scenarios that we're going to look at: max profit, profit, break even, loss, max loss, and it all depends on the value of SPY at the end of expiration. Essentially, for every single situation, your profit / loss is going to be the following formula: the long put value minus the short put value minus the premium that you paid. In the situation where SPY is trading at $395, you're at max profit, and really any time that the stock price would be under that short put, you'd be max profit at expiration. So how do we calculate that? Well, at $395, the short put would be worth $1,800 because that's the intrinsic value. You'd be able to sell at $413 and buy at $395, right? So the difference is $1,800, and since you sold that, it would be a negative thing, right? But you also bought a long put at the 416 strike, which would be worth $2,100. Because once again, that's the intrinsic value, the difference between selling at 416 and buying at 395. And the premium pretty much never changes, right? You paid $200. So the max profit would be 2,100 minus 1,800 minus 200. So that would give you $100 profit as your max profit. Let's say you weren't as good as you thought when it comes to short-term predictions and the SPY ended up at 413 and 50 cents. Now, you'd still make profit, but you would make less, and let's explain how. So that 413 short put would actually be worth $0, right? Because the intrinsic value would be 0. You wouldn't want to sell at 413 when you could sell at 413.50. So whoever bought that put from you wouldn't be exercising it. But the 416 put that you own is worth $250, right? So it has value. 250 minus 0 minus 200 gives you a profit of $50. Next, we have the break-even point. So in order to do this quickly, you can really just take the long put strike minus the premium. So 416 minus 2 would be 414. So you know while you're in the trade, if the stock ends up at 414, that's where you make no profit, no loss. Anything below that, you start to make money. Anything above that, you start to lose money. Uh-oh, it's at 415. That means you would lose $100 because now the long put is only worth 100 and you still paid 200 for the spread. So a loss of $100. Lastly, we got the max loss, which no one likes to see, but it's important to understand. Essentially, any price that's over the long put strike is going to be a max loser because neither of the puts will have any value at the end of expiration. So 0 minus the premium that you ended up paying 200 for a max loss of minus $200. At the end of the day, we make money if the stock is below that short put that we sold in the spread, right? We'll get the max profit at expiration if it stays below there. And then obviously max loss is above the long put. And anywhere in between, you either have small profit or small loss. Now, there's also an ideal environment where you want to use a bear put spread, and that's where there's low implied volatility in the stock that you're trading. So let's talk about that. One way to gauge the implied volatility for an underlying that you're trading is this number right here. On the Tastyworks platform, this is the implied volatility rank. So usually when this is low, it's better to put on a bear put spread, and when this is high, you would rather switch to a strategy that actually does better when implied volatility is high. So something like a credit call spread. So that's important when I'm putting on a trade for SPY and I want to be bearish. I'm always looking at the implied volatility to determine which strategy I want to use. So in this situation, it's lower. I'm okay with doing a bearish put spread. And to explain on that further, the reason you want to put on a bearish put spread in a low volatility environment is because if the market crashes, you have short delta with the bear put spread, but then you also get the benefit of the expansion in volatility. So you'll get to your profit target faster with a bearish put spread versus another bearish strategy such as a credit call spread, which the expansion of volatility may end up hurting you. The other two benefits when it comes to trading spreads is the capital efficiency. So realistically, for this trade that we just talked about, you only need $200 to put on that trade in order to short the market. Whereas if you bought a put, it would require a lot more capital and it'd be more capital intensive to get directional or play volatility, things like that. And then secondly, it's defined risk. So you already establish how much you can lose and how much you can win when you enter the trade. So there's no worry about shorting the market and getting absolutely destroyed on the upside if the market just continues to moon and you're short a naked call, right? That's what's great about these spreads is that you lock in how much you can lose up front. There you go, that's a bear put spread and the strategy with the pros and cons. I know it can be a lot for someone that's first learning about options, so if you need to watch this video 4 to 5 times, that's okay. But in all seriousness, if you did enjoy the video and learn something, please consider giving a thumbs up, as well as subscribing to Main Street Wolf, where I'll continue to cover individual option strategies down the line, so you guys can continue to learn. Thanks guys, and have a great day.